In this video, we'll focus on key features of accrual accounting and illustrate how accrual accounting differs from cash-based accounting. The principles of accrual accounting rest on the conviction that an assessment of the company's financial position and performance is better based on information about a company's economic resources and claims, and on any changes in these resources and claims, rather than solely on information about cash receipts and cash payments. We'll illustrate the key features of accrual accounting for a retail company that sells household appliances and draws up its annual statement of profit or loss for the year to the 31st of December. Assume the following transactions. The company takes delivery of 5 washing machines on December the 15th and pays the supplier on the 31st of January. The total purchase cost is €1,500. The machines are sold on the 6th of January and payment of €2,000 is received from the customers on the 12th of January. Given that the months of December and January belong to different accounting periods, how should we deal with these transactions? The first obvious question is, when should the purchase of the washing machines appear in the company's financial statements? The washing machines were acquired by the company in December, but paid for at the end of January. The question is, should the purchase appear in the company's financial statements in December or in January? A fundamental principle of accrual accounting tells us that transactions have to be recorded when they affect the company's economic resources and claims against these resources, and according to how they affect these resources and claims. When a washing machine, for example, is delivered, a company is free to dispose of it in any way it wishes, up to the point at which a customer agrees to buy it. In this example, the company controls the washing machines from the time of delivery, and a debt is owed to the supplier from that time on. The company does not have to wait until it's paid for the washing machines to determine their use. So, at delivery date, the purchase of the washing machines creates a resource for the company and a claim from the supplier for an equivalent amount of €1,500. So what about the payment on the 31st of January? This is a completely separate transaction. Paying the supplier will have its own individual effect on the company's resources and claims. By paying the supplier, the creditor's claim will be settled and, at the same time, the company's cash resources will decrease. This must be recorded as a separate transaction in the accounting database. In January, the sale takes place. The company delivers the washing machines to the customers on January the 6th and receives payment a week later. So, the question is, do we need to record the sale on the date of delivery or when payment is received? Again, accrual accounting demands that we think about how the sale affects the company's resources and claims. When a customer receives a washing machine, it's no longer available as a company resource, and the customer owes the company the sales price. Economically, the transaction takes place at the moment when the customer agrees to buy the washing machine. Legally, the machine is theirs from the moment they agree to buy it, which means the company selling the machine no longer has the right to determine its use, and the customer has a legal obligation to pay the agreed sales price. The transaction creates a trade receivable. This is a promise to receive payment at a later date. This promise holds future economic benefits and, thus, represents a resource for the company. So, importantly, in accrual accounting, we need to distinguish between 2 accounting transactions for the purchase and 2 accounting transactions for the sale. For the purchase, we need to distinguish between the receipt of the goods in the company's warehouse and the company's payment for the goods. Economically, each transaction has its own individual effect on the company's resources and claims. In contrast, in a cash-based accounting system, the company's purchase of the washing machines would be recorded as a single transaction at the point when the supplier is paid on the 31st of January, and the sale would be recorded as a single transaction at the point payment is received from the customer. The first principle of accrual accounting tells us when transactions should be recorded in the accounting system, but not when and how to measure profit. The second principle of accrual accounting states that financial performance should be measured when transactions affect the net wealth of the company's owners. So, our next question must be, at which point in time is there a change in the company's net wealth? Is it when the washing machines are purchased? When the purchase is paid for? When the sale is recorded? Or when payment is received from the customer? When the purchase took place, the transaction created a resource and a claim for the same amount of €1,500. There was no real effect on the company's net wealth at that point, as the company's net assets didn't change. The sale, however, does cause a change in the company's net wealth by €500, because the value of the resource received from the customers, the receivable of €2,000, differs from the purchase price of the washing machines delivered, which is €1,500. This brings about an increase in net assets, and thus in the owner's net wealth. So, it's the sale that triggers profit, not the purchase, nor any cash payment. The next question is, how and to what extent does the sale affect profit? In that regard, accrual accounting tells us that revenue and expense relating to a transaction is recognised in the same accounting period, and that is in the period the transaction takes place. For the washing machines, this means that revenue and expense are recorded on the 6th of January. The decrease in the inventory of washing machines is recognised as an expense at the moment of sale, while the trade receivable from the customer creates an increase in resources and results in revenue. It's fundamental to note that revenue and expenses are recorded only for a profit-triggering event, in this case the sale, not the purchase. So, the statement of profit or loss for January of year 2 shows a profit of €500. Recording the transactions in the company's accounting system, according to the principles of accrual accounting, would lead to the following. As our starting point, let us assume a nearly empty balance sheet with owner's equity of €10,000 and the equivalent amount in cash. On the December the 15th delivery date, the purchase of the washing machines creates an additional resource for the company, referred to as an inventory asset, and a supplier's claim called a trade payable or trade liability, each for €1,500. At the end of December, the company has not yet sold the washing machines and is still able to determine their use. They appear as an asset in the statement of financial position, also known as the balance sheet, as at the 31st of December in year 1, with a corresponding liability to the supplier. On January the 6th of year 2, the sale of the washing machines triggers a profit. The customers owe the company €2,000. This trade receivable creates an increase in resources and revenue. Simultaneously, the decrease in inventory resources needs to be recognised as an expense for its purchase cost of €1,500. The annual statement of profit or loss generated on the 31st of December year 2 shows a profit of €500. This represents an increase in the company's net wealth and is shown as an increase in owner's equity. When the customer pays on January the 12th, the accounting system will record a swap of a receivable for cash of €2,000 with no effect on net assets. The payment to the supplier on the 31st of January can be seen as a settlement of a liability, just like the payment of any kind of debt. So, both in year 1 and in year 2, the account balances will be shown as follows. In year 1 at reporting date, there is no effect on profit and no effect on the company's cash position. In year 2, the statement of profit or loss shows a profit of €500 and there is an equivalent net change in the amount of cash. Let us now consider an alternative scenario, Case B. For Case B, let's assume that the company is able to sell the washing machines on the 20th of December in year 1, instead of in January of year 2, but that the payment dates remain the same. Applying the accrual principles presented earlier, profit will now be triggered in year 1, after the sale of the washing machines on December the 20th. We now notice a disconnect between profit and cash flow. Year 1 shows a profit of €500, but there's no effect on cash, while year 2 shows a net positive cash flow of €500, but no profit. A cash-based accounting system would recognise financial performance only at the point where cash changes hands in year 2. So, to sum up, the 3 fundamental principles of accrual accounting you need to remember are as follows. First, transactions have to be recorded when they affect the company's economic resources and claims against these resources, and according to how they affect these resources and claims. Second, profit is measured when a transaction affects the company's net wealth. Third, revenue and expenses essentially represent changes in resources and claims due to a profit-triggering transaction. Revenue and expense relating to the same business transaction should be recognised in the same accounting period, and that is the period when the transaction takes place, even if related cash flows occur in a different period.